Hi friends, please do not skip this video and go towards the end of this video to just see the name of the safest stocks, because I genuinely want you to understand the method and the process that I am going to follow here, because depending on when you are watching this video, the list of stocks will completely change because of what I call as valuation risk that I'm going to walk you through. So let me now walk you through the step-by-step process of how to find the safest stocks. So what you see on my screen is more than 4,800 listed stocks, and our job is to find the safest stocks. So the natural question that comes in our mind is, what is the meaning of the safest stocks? So the safest stocks are the stocks that have the lowest risk of losing money, but at the same time can give us reasonable returns. Let me quickly break it down for you. What do I mean by lowest risk and how do we measure it? If I were to arrange all the stocks listed on the stock exchange in the order of the risk, then we need to pick those ones that have the lowest risk. It does not mean that the risk is going to be zero. What it simply means is the stocks that we are going to find out have the lowest risk. The second component is losing the money. What do I mean by losing the money here? The first principle of investing is that we need to protect our capital, and as long as we can make sure that we do not lose the money, we are going to be okay with investing in these stocks. For that, the minimum investment horizon we need to look for is minimum 3 years. If you are looking to invest for less than 3 years, then there is always a chance of you losing the capital as well because of the volatility in the stock market. And the third component is the reasonable returns. By reasonable returns, I simply mean our objective here is not to earn 50% return annually. Our objective here is to beat the benchmark index returns such as Nifty 50 that has been traditionally giving roughly 12%. Our objective is to get to somewhere around 15 to 20% of annual returns. That is what we are after. The first filter that we are going to use is we are only going to look at the top 100 stocks, because these are the well matured and established companies and our risk is minimum here. So what I'm going to do is go to the stock universe and filter only the top 100 stocks. Now comes the second criteria, which is the market risk. Every stock goes through a market risk. Let me explain to you. Whenever overall market falls down badly, you will see that the stocks will start to fall because of overall sentiments in the market. There is no problem in individual stocks, but still they are falling down. And COVID is a great example for that we saw that during the first few days of COVID, the market was down by almost 33%. Every stock was beaten down, although there was no problem in the individual stocks. For that, what we need to do is apply a filter criteria, what I call is beta, which tells us the sensitivity of the stock with respect to its market. Meaning, if the market falls by 1%, by how much the stock is likely to fall. So if the stock falls less, then that stock is less risky compared to other stocks. So for that, what we are going to do is look at the beta as one of the criteria and introduce it here. And let us go ahead and sort this list out by the beta. So let us see. You will see in the top 100, these are the listed stocks in the ratio of beta. Let me find out the lowest beta ratio here. And you will see that Hindustan Unilever is showing us the lowest beta, which is least sensitive stock when it comes to the market fall. So we are going to be relatively safe if we consider these stocks which are having the less beta. Now, how much beta we should go for? In my simple view, I will go with any stock that has beta less than 1, simply meaning that the stock is going to fall less as compared to market. Let me go ahead and put that filter here, less than 1, and that way we get only 52 stocks. Now, one thing that you will quickly note here from this list is all the banking stocks such as State Bank of India, HDFC, ICICI are not appearing in this because banking stocks are most volatile. Even if we look at during the COVID, you will notice that the Nifty 50 fell by roughly 33%, while Nifty Bank fell by almost 43%. So it is absolutely okay to not have banking stocks because we are talking about the safest stocks. I'm not at all saying that HDFC, SBI, ICICI, Axis Bank, they're not safe stocks. My point is very simple. They are more volatile. And this video is all about finding the stocks where the volatility is less and as well as our risk is less. So take it from that perspective. The second biggest risk that every stock faces is the valuation risk. Let me quickly explain to you in a very simple language. What I mean by valuation risk is that let us say you invest in a stock right now and the stock is overvalued. Now what may happen is that if a bad news hit the market, what is going to happen is the people who have invested in that stock are going to sell that stock all of a sudden in order to book the profits, and that will mean that the stock prices will come down crashing. And if you invested in an overvalued stock at the time when it was overvalued, you as an investor are going to lose a lot of money. Practical example of tomato prices right now. Tomato prices right now are soaring like 200 rupees per kg kg, 300 rupees per kg. And for example, if I think that, oh, the tomato prices are going up, let me go ahead and stock 1000 kgs of tomato and sell it in the market, and tomorrow all of a sudden when the prices get corrected, I am going to lose a lot of money. So therefore, if we want to take the safer bets in the market, then what we really need to do is check whether the stock is overvalued at the time of investment or not. And for that, what we are going to do is look at two simple ratios. Let me quickly add them. Number one is we are going to look at PE minus sector PE, meaning that what is the sector PE versus the company's stocks PE right now. But there is always a limitation with PE ratio. I've explained this in my previous videos. If you have not yet subscribed to the channel, please do so that you can go ahead and watch these definitions. Very, very important. In order to overcome the limitation of PE ratio, what I'm going to do is add something called as PEG ratio. So let us go ahead and add PEG here. We are going to be okay if the PE minus sector PE is less than 5. So I only want to consider those stocks where the PE minus sector PE is less than 5, meaning they are more or less undervalued. From a PEG ratio perspective, it is said that if the PEG ratio of a stock is less than 1, it means it is undervalued. But right now, Indian market is highly overvalued. We are not going to find stocks which are showing PEG ratio of less than 1. So for now, I am going to consider those stocks that have got PEG ratio of less than 3. That is good enough for now. So this gives us total 16 stocks which are less sensitive to the market, as well as they are right now undervalued. So far, if you're liking this video, please hit the like button. The third big risk every stock faces is the profitability risk. Now you might say to me that, Rahul, there may be a reason that these stocks are undervalued because they might be not profitable right now, which is what we need to find out. So for that, what we are going to look at is their track record of profitability. So for that, what I'm going to do is going to have a look at their 5-year historical EPS growth, earning per share growth. Also, I want to look at their 5 years average net profit margin to make sure that they have consistently been profitable. So let us go ahead and add those two filters, and we are only interested in those stocks that have shown at least 10% of earning per share growth, as well as at least 10% of net profit margin growth. So let us go ahead and add them here. That gives us total 12 stocks. Also, we need to look at the last financial year's net profit margin as well to make sure that there is nothing wrong going on with the company in the last financial year. So let us go ahead and add that here as well. So we are going to add net profit margin here as well. So let us go ahead and add that. And I would only like to consider those companies which has given me at least 10% of net profit margin in the last financial year. That gives us total 11 stocks. Also, let us go ahead and add last 1 year's historical EPS growth. So let us go ahead and add 1 year's historical EPS growth. So for example, here, let's add this filter as well. And we want to make sure that we only select those stocks where the last 1 year's historical EPS growth has been more than 10%. That gives us total 9 stocks. So these 9 stocks in the last few years have shown good track record of profitability, meaning that they're undervalued not because of the profitability reason, it might be some other reason. Also, we must check the future prospects of these stocks as well. So for that, what we are going to do is we are going to look at 1 year forward EPS growth prediction. This is merely a prediction. It only gives us some indication. It is not going to be the reality, maybe, may not be, right? So what we are going to do is add 1 year forward EPS growth, as well as we are going to look at 1 year forward EBITDA growth. Here in this tool, I am not able to find next 1 year's net profit margin predictions. Otherwise, I would have added that. But for simplicity, let us go ahead with 1 year forward EBITDA growth again, and let us add these two filters. And what we see here is, for example, Coal India and Britannia Industries are reflecting or are estimating to be showing the negative earning per share growth. Therefore, what we are going to do is we are going to remove those stocks that are showing the negative EPS growth in the coming year. So I am only going to look at those stocks that are going to give me positive EPS growth. So let us go ahead and add that in here. And as well as from a EBITDA growth perspective, I am only interested in those stocks that are predicting to be giving me positive EBITDA growth in the next 1 year. With this, we get to the 7 stocks that are not showing any profitability concerns right now. So far, we have learnt about market risk, valuation risk, profitability risk. Now I want you to learn about liquidity risk. What I mean by liquidity risk is that if the company does not have cash, it might struggle. Also, if the company has huge debt, it might struggle. So for that, what we are going to do is we are going to add another filter called as free cash flow. So let us go ahead and add free cash flow here. And we want to make sure that each of these companies have positive free cash flow, which is what you can see on the screen. So all these 7 stocks are okay from a cash flow perspective. The next check that we are going to do is also look at their debt to equity ratio. Let us go ahead and add debt to equity here. So I'm going to add debt to equity here. Let us go ahead and add that. Now, debt to equity ratio is largely dependent on the sector in which the company is operating. So for example, these 7 stocks that we see, mainly they are from pharma sector or from IT sector or from FMCG sector. And if I just quickly show it to you how to go about looking at it, from a IT perspective, if you look at the industry average of debt to equity ratio, it is roughly 13%. And right now TCS is at 7.16%. So from that perspective, we are okay. Likewise, if you look at the pharma sector, so look at the Dr. Reddy's data here. It is showing me the debt to equity ratio of roughly 16.42% in the last 5 years. And the industry is at 28.21. This is the way that you go and check the debt to equity ratio of the sector and compare whether the stock is operating at a less debt to equity ratio versus the sector or whether it is at the high, so that you can understand the risk that you are taking. So from this perspective, I've gone through all these 7 stocks and we are looking okay that these stocks do not have higher debt to equity from their sector perspective. So far, if you're liking this video, please hit the like button. Also, you can consider joining my member community where I regularly post comprehensive in-depth analysis on individual stocks. Also, a big shout out to Nitesh Sharma who dropped this comment on my filters videos. It definitely made me laugh and I think this is one of the best comments I have received so far. Thank you so much Nitesh for that. Now coming back to these 7 stocks, do you think we should go ahead and invest in these 7 stocks? Do you think these are the 7 safest stocks? Well, not yet. What I really want to do is also explain to you solvency risk and as well as governance risk. For that, what we are going to do is, so go to Value Research website and go ahead and search for that particular stock out of these 7 stocks. For example, I have taken Dr. Reddy's here, and what you are going to see is that if you go down, you are going to find solvency risk here, or something called as Altman Z-score. I've explained that in my previous videos as well. So what you see here is that what is the threat for this company's solvency in the future? It is showing not likely. It is very important that we check the solvency risk of the company as well as the governance risk, meaning is there any manipulations going into the balance sheet or the financial numbers of this company or not. And you see here right now the modified C scores for this company, Dr. Reddy's, is 0. This actually means that there is no problem when it comes to the financial numbers that have been reported in the books. Extremely important check that you must do in the penny stocks that I explained in my penny stocks video, as well as whenever you are looking for safest stocks, you must make sure that you perform these 2 checks. There are 3 additional risks that you must be aware that I cannot cover using these filters. One of them is the regulatory risk. For example, have a look at Delta Corp, one of the stocks that I talked about in depth in my member community. Consider joining my member community because that is where I post individual stocks analysis. And to quickly summarize, what you see on my screen is this stock has fallen from levels of 246 to roughly 179 rupees per share within just few days because of the changes in the GST that the regulators want to bring in. And this is where one of the risks that you cannot predict and you must be aware of it. The second risk that I cannot cover in these filters is the management risk, meaning if there is a fundamental change in the management team, then the stock is likely to fall on the back of this news. Again, this is something that you need to be fully aware when you're investing in stocks. And lastly is the headline risk, which is the news that might crash the stock price like anything. Again, that is something that you need to be aware. You can't do anything about it. It may just happen anytime. So let me read out the names of the 7 stocks here. Number 1 is TCS, number 2 is ITC, number 3 is HCL, number 4 is Sun Pharmaceutical, number 5 is Cipla, number 6 is Dr. Reddy's Laboratory, and number 7 is Bharat Electronics Limited. This list is a short list. It is not a recommendation by any means, and depending on when you are watching this video, some of these stocks might become overvalued at the time. So it is very important that you learn the method and do not just invest blindly in these 7 stocks. Also perform complete in-depth analysis on these 7 stocks, but this is a good short list for you to start doing further analysis to find out the safest stock that you want to invest in. Let me know in the comments, in your view, which are the safest stocks right now. Also, point number 2 is that there are a lot of scams going on my name. Please be aware that I never reach out to you individually via WhatsApp, Telegram, email or Instagram, and never ask for any money from you. Please be very, very careful. Do not give a single rupee to anybody pretending to be me. Lastly, you can also follow me on Instagram or LinkedIn. You will find my social media handles in either description or as well as in the comment section. I hope you enjoyed this video and learned something new. I will see you in my next video. Until then, keep rocking.